Welcome to North Main Financial with Joshua Dobi, presented by the North Main Financial Group in Cornelius. Joshua Dobi has been helping clients with their financial needs for over 2 decades and has registered to work with numerous tools for your long-term success. North Main Financial is big enough to help, but small enough to care. Visit them online at northmainfinancial.com. That's northmainfinancial.com. Here is your host and community investor and financial advisor, Joshua Dobi.
Hello and welcome to the North Main Financial Show. I'm your host, Joshua Dobi. Thank you so much for tuning with us into this week's version of the North Main Financial Show. And, as a previous listener, we're talking on any number of subjects here. And often, in that economic and financial universe, we're taking a look at things on a macro level, if you will, global, understanding what's happening in the world around us and seeking to understand how those kinds of things affect all of us. But we also seek to break it down to an individual level, a micro level, if you will, looking at things that may be part of your experience or perhaps the experience of other folks in your family, colleagues, etc. Again, hoping to give some things that can spur some thought and hopefully encourage you in healthy ideas and decision-making practices when it comes to economics and our finances. But in doing so, you recall, again as a previous listener, that nothing that we're talking about here is intended as a specific recommendation for you. Meaning that even though we're talking on specific strategies, we're probably going to even talk on specific companies. At least I'm going to be talking about some sector-related things today for sure in this week's show. Again, nothing that we're talking about here is intended as a specific recommendation for you. We strongly, strongly recommend that you reach out to your tax advisor, to your financial advisor, or if you'd like to reach out to us at North Main Financial Group, love to chat with you, love to hear about your particular financial journey and to see if there are ways in which we might be able to be helpful to you. Online, you can find us at northmainfinancial.com. That's north like the direction, main like the street, financial.com. northmainfinancial.com. We have a contact page on there. You leave us your email address or a phone number. Let us know the most preferred and desirable ways for us to contact you, again, at northmainfinancial.com. You're also welcome to call our office at any time, 704-987-1425. Again, 704-987-1425. And one more time, 704-987-1425. All right, again, thank you so much for tuning in to this week's version of the North Main Financial Show. As I mentioned a moment ago, my name is Joshua Dobi. I'm a certified financial planner, or CFP professional, and as has become really our format structure here, I don't want to get too locked in. I certainly don't want to bore you with how we're looking at things. But I think for some pretty important reasons, we've been taking a look at a lot of macro data when it comes to the economy. Not that we're staying there. Actually, in the second half of this week's show, a little bit of a teaser, we're going to talk about some things that you probably want to keep in mind when it comes to not just the macro data, but how it can apply to you and be helpful to you in making decisions for your portfolio, for your investments. But here on the front end, definitely want to take a look at some of this macro data, and I'm going to start with the Federal Reserve. Now, you probably don't watch these things or listen to these things as closely as I do. At least I hope not. I hope your life's a lot more exciting than that. But we had some notable movement, or really I should say lack of movement this week from the Federal Reserve, actually just yesterday as of the time of this live broadcast or as of the time of this recording, if you happen to be listening to the podcast version. We had a lack of movement by the Federal Reserve for the first time in very nearly a year and a half in terms of an adjustment to the overnight lending rate, or what we sometimes call adjustment to interest rates in the more casual vernacular. And that was noteworthy from the standpoint that in the previous 10 times that the Federal Reserve has come together for their meetings, which are very nearly every month. They skip a couple of months along there for holidays and for other reasons, but very nearly every month here over the course of the last year and a quarter to almost a year and a half, they have raised the overnight lending rate. In some cases, as much as 75 basis points at a time. Yesterday, they didn't, and that was pretty well forecast. That forecast isn't even a good way to describe it. It was all but promised coming from the Federal Reserve, especially coming out of last month's meeting, that they were probably going to put a pause on, meaning that they weren't going to raise rates at this particular meeting. And in fact, that happened yesterday. I think the market, by and large, anticipated that, certainly with regards to what we saw in the bond markets, the equity markets. Definitely looked like that the market was overall expecting that. There wasn't much movement when the news came out. There wasn't much space where the surprise factor, if you will, or the boy, we didn't see that coming. And the Federal Reserve's usually pretty good about that. They don't want to unnaturally surprise the markets. They don't want to be too predictive, but they definitely don't want to surprise the markets. And you could definitely see that in the course of yesterday's movement in the markets, this morning's movement in the markets, overseas movement in the markets. I mean, it was fairly predicted, and I think that's you can make arguments both ways, right? I think that's a fairly good thing, though, just my personal look at it, because it does reduce the shock value into the system, but it also hopefully gives us a little bit of an indication about where the Federal Reserve's minds are. And you may say, well, what in the world does it matter what the Federal Reserve's doing? Why does it? Yeah, and fair point. Until I tell you, if you're a first-time listener to the North Main Financial Show, what they do with interest rates in a given time frame literally affects just about everything that we do. Now, you may not say, well, it really doesn't. Actually, it does. You got a car loan, you have a credit card with a balance on it, you have a mortgage. These kinds of things are all affected by interest rates. So in fact, you are experiencing that. We're going to talk about that again a little bit more in the second half of today's show. But I want to come back to the Federal Reserve again for a moment to say, yes, they paused yesterday. Yes, they did not adjust the overnight lending rate, which right now is between 5.25% and 5.5% right now. They did, however, and this is a very important point, they have been very upfront also. I would say in the same ways that they really had broadcast in advance that there was a likelihood of a pause in their raising cycle yesterday, they've also been very intentional about saying that there's probably going to be more raises in the future. And that's, I'll just share from my standpoint, that's challenging. That's challenging to digest, because now we're still with a target that we don't know where the end is. And I try to look at it from their perspective. I try to look at it from the perspective of the Federal Reserve and say, okay, you really are trying to steer a $28 trillion ship in real time, and you really can't know the effects of the decisions that you're making probably for at least a year. So I do respect that. I do have a lot of empathy for that. But also, we've made so much movement here over the last year and a quarter relative to interest rates. I don't think we have any idea where it's going to land. Now, some of the indicators about the health of the economy continue to be very positive. I think that's a very good thing. But we still don't know. We still don't know what the true effects of such a huge movement in interest rates in a short amount of time are going to be. Now, there are short-term kinds of things that we see, right? I mean, I've talked more about money market accounts and CDs here in the last year than I've probably talked about in the last 10 years combined. And the primary reason for that is because of where rates are. So now you can get 4 or 5+% inside of a short-term CD. There are money markets out there that are now 4 or 5+% in terms of their dividend yields. Obviously, that's a variable. It's always fluctuating. But I haven't been able to say that for 15 plus years, more than 15 years. And so there definitely are those elements. But then there's also the higher cost of capital element as well, meaning that if you're looking to take out a mortgage, I just had a meeting this morning with a client who's looking at a piece of investment property, and we were noting the difference between the mortgage rate that has been quoted now on their piece of investment property, which was in the sevens, which is in the sevens, and their primary mortgage on their home, their primary residence, which they refinanced here about 3 years ago at about 3.5%. So literally, they're looking at a cost of capital for this investment property twice of what it is on their mortgage on their primary residence. Now, a couple of other factors involved with that. I don't want to get too granular, but definitely striking. Because when you look at that from a cost standpoint, again, we're going to talk about this after the break here in a few moments, but when you look at that from a cost standpoint, that's a big deal. I mean, if you're a business owner with a line of credit or something, that directly impacts your profitability, because it's very, very hard. Let me say it that way. It's very, very hard to allow for, especially if you have a large line of credit with a big balance on it, it's very, very hard to allow for enough slush in your system or in your pro forma to be able to accommodate that. And I'm finding that with a lot of small businesses really challenging right now in terms of adjusting to lines of credit balances where they may be paying literally double in terms of the servicing costs. So very, very challenging space. Again, the Federal Reserve paused on rates, and now it looks like that they're going to be in a space where they're going to be getting back into it. Well, I'm going to take a few moments to take a deep breath to hear from our sponsors. You're listening to News Talk WSIC here on the North Main Financial Show. Hello, welcome back to the North Main Financial Show. I'm your host, Joshua Dobi. Thank you so much for sticking with us here and hanging with us into the second half of this week's version of the North Main Financial Show. And before I get excited and carried away, I know you probably don't get excited about things financial and economic. I do. But before I get excited and carried away, let me give you a reminder about ways in which you can contact us at North Main Financial Group. If you'd like for us to take a look at your portfolio, your investments, your strategy, overall financial plan, insurance program, all those things related to our financial lives, love to sit with you, love to chat about your particular journey and to see if there are ways in which we might be able to be helpful to you. Online, you can find us at northmainfinancial.com. That's north like the direction, main like the street, financial.com. northmainfinancial.com. We have a contact page on there. Leave us an email address or a phone number. We'll certainly set that time on the calendar, again, at northmainfinancial.com. You're also welcome to call us at any time, 704-987-1425. Again, 704-987-1425. And one more time, 704-987-1425. All right, again, thank you so much for hanging with us into the second half of this week's version of the North Main Financial Show. And right before we were going to break there, we're talking about some of the moves of the Federal Reserve, and I get it. That may not be the most riveting dinner conversation or any conversation at some level, but it's important in terms of just how much it affects our daily lives. I mean, I talked just briefly before break there about the kinds of things that are impacted by interest rates that literally it's a part of everything that we do. And I was talking about, a client with whom I was meeting this morning and, looking at their primary mortgage, which they refinanced here a couple of years ago at 3.5%. Now they're looking at some investment property, and the financing cost there is north of 7%. And for those of you who have investment property or those of you with mortgages and those good kinds of things, that's a very large difference, especially when you're talking about big numbers. That's a very large difference on a monthly basis in terms of your commitment to a payment. Meaning the payments are much higher, obviously, with a higher interest rate. And in this case, from the capitalization cost or from the interest rate cost standpoint, double what their experience had been. Looking at something, what they have at 3.5% and now north of 7% for this piece of investment property. So it's a big deal. And try to expand, if you will, with me on that thought process, because what that does is it shapeshifts. This might be intuitive, but I think it's important to say out loud that shapeshifts then how folks make decisions in their financial lives. And this is really where the personal applicability may come in here for you. When we look at that kind of thing, folks are making decisions then from the kinds of mortgages that they have. Maybe instead of going and buying a bigger, more expensive home, maybe they pause a little bit and they're waiting. You multiply that times hundreds of thousands, maybe even a couple of million folks who are in a similar kind of thought process, and all of a sudden you have a shifting in our entire economic structure, meaning in terms of the real estate market, if we're talking residential real estate in this particular instance. And we're seeing that from the big builders. If you look at the D.R. Hortons of the world, or you're looking at Lennar, and I'm mentioning them only because they happen to be some of the largest builders. NVR also some of the largest builders in the country. I'm not offering them up as a recommendation or anything like that, of course, but some of the largest builders in terms of the number of homes that they build on an annual basis, you're seeing them really pump the brakes. You're seeing them in terms of the new permits that they're pulling. You see them in terms of the new developments that they're starting. And you may live in an area where that's not the case. So I don't want to say that this is a blanket slowdown or a blanket kind of statement about where the overall market is or where it may be going. Not trying to do that. I'm really using generalizations here, but also with the caveats that you may live in an area where homes are still moving at a red-hot pace. And actually, we see that in certain pockets around the country. However, when we look at the overall country, when we look at what some of the largest builders are anticipating here over the course of the next number of months, and certainly in the next year to 18 months to 24 months, we're definitely seeing some folks pump the brakes. I mean, think about it. If your income hasn't changed, so I'm going to make this very granular for you here. If your income hasn't changed, and let's say you're renting right now and you were looking at mortgage rates in the 3.5–4% range here a couple of years ago, and now you're looking at mortgage rates in the 7% range right now, and you're looking at buying possibilities, that changes, meaning that you may not be looking to purchase at that point. Or you may say, you know what, if we were going to purchase at this level, we may be 20, 30, 40% lower in terms of our purchase price in order to be able to accommodate that in our monthly budget. So there's a very real-world applicability to what we're talking about with interest rates here, and we see it constantly. Like I said, literally just before we came on air today, I was talking about that with a client and how they're going to approach it. Now, this is investment property, so we're talking about rents and we're talking about leases and we're talking about the kinds of things that they may be able to generate in terms of income from it. But it's a different pro forma. It's a different kind of planning process with capitalization rates now where they are than it was here a couple of years ago, and really in sizable ways, not just a casual movement, but literally historic in terms of the amount of movement in interest rates in such a short period of time. So I know I'm maybe beating that a little bit to death there, but very, very important for you to keep that kind of thing in mind because it does affect our decision-making behavior. And then when you look at it across the country, it definitely shape-shifts, if you will. But all right, so we've got the Federal Reserve putting a pause on raising rates here, probably going to get back to raising rates here, possibly at their next meeting. Certainly they're leaving that door wide open, perhaps even being a little bit predictive and saying that they're going to do that. So we definitely want to keep an eye on that. That's going to shape-shift the markets. But I got to come into the markets right now, especially the equity markets, and it almost is a tale of two cities. You literary types will know that reference there, but it literally is a tale of two cities right now, or two different markets. And there are a couple different ways to slice this pie. I'm going to come at it in an example of the difference between, let's call it the more value end of the markets, and then what I'll call the more growth end of the markets. Value end tends to be more established, blue chip, a little bit stodgier in terms of growth, and then when you're looking at the other end of things on the growth end, tend to be more aggressive capital appreciation style companies. Let me put it this way. Let me say that on the value end, we think about things like BP Amoco, Chevron Texaco, Eli Lilly, Pfizer. That would be more on the value end of the universe. On the more growth end of the universe, that tends to be a lot of technology companies, Amazon, Meta, which the former Facebook, NVIDIA, AMD when in the semiconductor space, Microsoft, even with as large as they are, still very much more in that aggressive camp. So when we're looking at the dichotomy there, we're looking at value on one end and growth on the other. When we're talking about year-to-date performance, and ready or not, folks, we're almost to the halfway point of the year. I mean, a couple of weeks here, and gosh, we're going to be into July, ready or not. So literally the halfway point in the year. But when we're looking at that from a performance standpoint, very interesting to see how different the markets are behaving right now. And yes, this is linked to interest rates, and yes, it is linked to the strength of the economy and a whole bunch of other variables in that algorithm. But very, very interesting to see. And I'll draw it out this way. In the value end of the universe, let me talk sectors here for just a moment. Healthcare, the utilities kinds of things, energy. So energy, think oil, natural gas end of things. They've all had negative years. Meaning those sectors, as measured by our most popular indices, are all in the red for the year. Now, not huge. We're talking about somewhere in the 3 to 9% range negative this year, but still negative for this year. And then the other side of the universe, the other end of it, where the growth-oriented, especially technology-oriented companies, semiconductor kinds of things. I'll tell you what, if you even mention the two letters together of AI, it's been a great year almost across the board for those kinds of companies. Not all, but for many of them that has been the case. It has been an explosive year. I mean, there are companies which are positive 50, 75, 100% just since January 1st. We're not even through the halfway point in the year. Now, some of those companies got beat up last year, so you can make an argument that some of this is rebound kind of movement, and that would be legitimate for looking at that. But I'll tell you, that kind of movement is unnatural. I'm very thankful for our clients. You may be some of them who have those holdings which have appreciated so quickly here in a very, very short amount of time. Very thankful for that. But friends, I got to tell you, legitimately, if I'm doing my job correctly here, that's not natural. That's not a normal kind of occurrence where something would appreciate 50, 75, or 100% in value, and I'm talking market capitalization, in the course of less than 6 months. It's just not a natural sort of thing. Thankful for it, especially if you own some of those. Really thankful for you. But let me offer up that one of the things that you may want to consider here, and this is very important, you may want to trim some of those gains. Everybody's situation is unique. That's not coming as a recommendation, but you may want to take some of that proverbial cream off the top. I mean, that is a huge amount of movement in a very short amount of time. And I get it. We think in straight lines, especially when it comes to the markets. And when something's growing, very, very rapidly, we actually, counterintuitively, want to put more money into it, right? Because we think it's going to keep going straight forever. Friends, this moves like waves on an ocean. It doesn't happen that just because something has gone up tremendously that it will continue to go up tremendously, at least not in perpetuity. So sometimes a good strategy to consider is maybe take some of that cream off the top. Maybe take some of those gains, stuff it away in someplace safe, let the proverbial ship come in a little bit so that maybe you can buy some things on the cheap as those things kind of normalize in terms of their performance. Again, going up 50, 75, 100% in less than 6 months, I don't care how bad it was before. That's just not a natural kind of movement. I say the same thing when markets are in the negative, that kind of movement also is not natural. So that, thankfully, I don't have to talk about that as much for right now. Well, friends, we're rapidly approaching the end of this week's version of the North Main Financial Show. Let me do a lightning fast recap here about where we've been. Federal Reserve took a pause on raising rates, but they've left the door wide open that they may be raising rates in the future. So we're definitely not out of this raising cycle yet. Definitely important when it comes to your overall plan. Looking at the equity markets right now, and we see where things have been. We see the value end of the universe that has been flat to even negative this year. Very interesting to see that. And then we see the more aggressive end, the tech end of things right now, just explosive. Not every company, but just explosive in a positive way. It may be wise to consider taking some of those gains off the table, perhaps pausing a little bit before you want to go forward. Well, friends, it has been a pleasure to be with you on this week's version of the North Main Financial Show. My name is Joshua Dobi. Until the next time, I'll talk with you soon.
You've been listening to North Main Financial with Joshua Dobi from the North Main Financial Group in Cornelius. Find out how Joshua and his team can help prepare your financial future at northmainfinancial.com. That's northmainfinancial.com. Listen to the past shows on demand at WSICweb.com.
Securities and investment advisory services offered through SagePoint Financial Incorporated. Member FINRA SIPC. North Main Financial Group LLC is not affiliated with SagePoint Financial Incorporated. Investing involves risk, including the potential loss of principal. The views expressed in this radio show are not necessarily the opinion of SagePoint Financial Incorporated.
All investing involves risk, including the potential loss of principal. No investment strategy, including buy and hold and diversification, can guarantee a profit or protect against loss in periods of declining values. Past performance is no guarantee of future results. Please note that individual situations can vary, and therefore this information should only be relied upon when coordinated with individual professional advice. This information is not to be taken as investment advice or